Hello, welcome to the online edition of the Introduction to Microeconomics. My name is Elias. In this video, I'm going to take you through Unit 1 of Economics, which is the Introduction to Microeconomics. Now, in this unit, we are going to develop economics, start from build the foundation, and then as we go on, we'll be adding to whatever we'll have discussed here. So I urge you to understand, to follow through what will be happening here, and then make sure that you don't forget these things, because there'll be a foundation to everything that we're going to talk about in the future. So let's look at the outline. Okay, so we are going to define economics, and after that we'll look at the basic concepts of scarcity, choice, rationality, opportunity cost, and the marginal concepts. Under this second bullet, we will look at the world of economics, and specifically we'll distinguish between microeconomics and macroeconomics. We will also distinguish between positive economics and normative economics. Then beyond this, we're going to look at reasons why and how to study economics, as well as the methods that are used in economics. For further reading, you can check Mankiw chapter number 1 and 2, and McConnell chapter 1 and 2. Alright, let's get started with the definition of economics. So economics is the study of how society manages its scarce resources. In other words, it is the study of choice under conditions of scarcity. As we make our decisions and our choices, we always take into consideration the fact that we cannot have everything that we want, because resources are scarce. And therefore, given that we are faced with unlimited wants, we have unlimited wants and faced with scarce resources, then we have a big problem of scarcity that we need to deal with. We need to work out how we are going to maximize or satisfy our interest in everything that we do. Therefore, given the problem of scarcity, we need to make choices. Now, these choices are not made anyhow. Individuals make choices that are based, or out of whatever situation they have to make choices that will give them the best results. In other words, when making choices, you need to be rational. If you make rational decisions, then you will be able to achieve the desired results. In making decisions of production, or in making decisions, we need to decide first on what to produce. For example, you may decide that you're going to produce clothes. How to produce those clothes? You need to think about the techniques that you're going to use in producing the clothes. And finally, for whom to produce those clothes, you need to have the intended target. Now, because you are making choices, it means the alternative of producing clothes could have been maybe producing drinks. You decide that, okay, you're going to use your labor to produce clothes as opposed to producing drinks. So given these choices, you've decided to produce clothes. How are you going to produce the clothes? You think about the techniques, and for whom, you look at your target, the distribution. How are you going to give away those items that you have produced? Given this, we can now look at the opportunity cost, because out of all this, you will have to make the trade-off. You will have to give up some resources that were meant for the production of drinks to increase and channel them to the production of clothes, so that you increase the cloth production. So we are faced with a cost called opportunity cost, which is the value of the best alternative forgone. Let's look at scarcity and choice in more details. So scarcity is the limited nature of society's resources. In other words, Scarcity is a situation in which the amount of something available is insufficient to satisfy the desire for it. For example, if what you want is to maybe eat bread, and then you only find 2 slices when you were expecting maybe to find the whole loaf so that you can eat until you get satisfied. The amount of bread that you have is insufficient to satisfy your utility. Therefore, in this case, we say bread is scarce at that point that you are receiving it. In the words of Waldo Emerson, want is a growing giant whom the coat of have was never large enough to cover. We have our unlimited wants, but the capacity to obtain those items that we want is limited. So, want is a growing giant whom the coat of have was never large enough to cover. In the case of scarcity and economics, we study different problems. The problem of scarce resources and the choices which the scarcity forces us to make. We need to think of key players in the economy: the households, the firms, the government. From the side of the households have limited income to allocate among goods and services. Given this limited income, they need to make optimal decisions on the allocation of their income. They will have to decide how much they will save and how much they will channel to daily consumption. The firm is faced with the cost of production as a major constraint. In other words, the limitation on the firm's production capacity is the cost of production, which means that the firms cannot produce everything that citizens or people in the society need. The firm will produce based on their capacity. The plant size is another limitation for the firm. How big the plant is will determine how much items can be produced, and therefore this also shows the concept of scarcity. In the case of the government has the budget which it has to meet, and therefore this budget serves as a limitation to government's goals. These goals must be carefully chosen. Should the government construct schools or hospitals? In everyday life, we hear people complaining about the roads. Should government construct the roads? Or should government go and procure face masks to fight the COVID-19 pandemic? All these are choices that are supposed to be made in the presence of scarcity. So now, because choices have to be made, it means that people or institutions making those choices must be rational. The assumption of rationality implies that people take full account of all information available to make their decisions. The people who are making choices, they know what will happen, they know what happened, and they know what is likely to be in their case. In the case of COVID-19, we know that if you do not wear a face mask, you do not sanitize your hands or wash your hands, you are likely to have COVID-19. Therefore, you have to decide on whether to wear a face mask or not. You have all the information at your disposal, and therefore the decision has to be made by you. The decisions we make are said to be rational based on how we have evaluated them. This means that the individuals will make different choices under different circumstances. One might decide to wear a face mask, where another person may decide not to. The justification could be that the one wearing a face mask has seen that if you don't wear a face mask, you may contract the virus. The one not wearing the face mask may have another view of saying, if I wear a face mask, I might suffocate. So different views will lead different people to make different decisions. However, all decisions made are rational from their point of view. In this regard, individuals pursue actions that will allow them achieve their greatest satisfaction. Wearing a face mask will prevent me from contracting the virus. Not wearing a face mask will help me breathe properly. This is out of my self-interest. But however, the government has its own role to play in the market. We will look at this when we come to the market structure, and look at why government intervene in the market. Some self-interest may not be optimal, and therefore it may necessitate that government intervenes. And you will understand why government is always asking people or telling people to wear face masks, because left to them, others will not wear it. Let's look at the opportunity cost, which is the value of the best alternative forgone. In other words, it is the amount of the product that must be forgone or sacrificed to produce a unit of a product. Now, when we say this, we mean it's the amount of one product that must be forgone to produce a unit of another product. This means that the opportunity cost of an item is what you give up to get that item. If you are faced with a situation of making a choice between going to church or going for a movie, if you decide to go to church, the opportunity cost of you going to church is not going for going for a movie. So if you had gone for a movie, the benefits that you will have acquired, those forms the value of going for a movie. And if you decide to go for a movie, the opportunity cost of going for a movie is going to church. So you need to understand the distinction here and be well able to define opportunity cost. Let's take a classic example. Suppose you want to spend a day watching a movie with your friends at the cinema, and the cost of doing so is 30 kwacha or inclusive. Suppose that you really like going to the cinema with your friends and that you will be willing to pay 60 kwacha to do so. Let's suppose further that the best alternative of going to the movie is to work at the campus shop at Unilas to earn 70 kwacha per day. And finally, suppose you like working at the campus shop, but only if they pay you at least 30 kwacha. Let's look at the questions that follow and try to answer them. What is the value of working at the campus shop for you? What is the cost of going for the movie? And finally, as a rational consumer, would you consider going for a movie or working at the campus shop? Now, let's try to answer these questions together and see how you connect with what you solved earlier before this presentation. Now, from this situation that we have, before we start answering, we should note two things: the cost and the benefit. The 60 kwacha, this 60 kwacha here, you are willing to pay for the movie, represents the maximum amount you are willing to pay for that activity, and therefore it represents the benefit in monetary terms. The second part is the 30 kwacha. We should note that the 30 kwacha is the daily rate at which you are willing to work at the campus shop, and therefore it is the minimum payment that will make you work at the campus shop. Thus, it is the benefit in monetary terms of working at the shop. So we have two. We have the benefit that we have the willingness to pay if we decide to go for the movie, and we also have the benefit that we will have if we work at the campus shop. Now, the value of me working at the campus shop is I have to evaluate the two. So I look at the difference between the 30 and the 60 and the 70 and the 30. So now that I've only considered the value of me working at the shop, it means my focus will only be the benefits that I will get, the actual benefits, and the perceived benefit. With that, the value of me working at the campus shop will be 70, which is the amount that I will be paid, minus the 30 kwacha, which is the amount that I was willing to offer my services. This means that the value of working at the campus shop is 40 kwacha. Okay, the next part of the question is asking us to find the cost of going for the movie. Now, if we are back here, we look at this situation, you can see that there are implicit and explicit costs involved here. The cost of going for the movie is not only the explicit cost of 30 kwacha. So the cost is not only this 30 kwacha. It also reflects the implicit cost given by the best alternative you are sacrificing. In this case, the value of the best alternative is 40. Now, this represents the opportunity cost of going for a movie with your friends. If you take into account this opportunity cost, then the cost of going for a movie with your friends is 70. That is, you have the 30 kwacha explicit cost. Okay, so you have this 30 kwacha explicit cost plus the value of working at the campus shop, which is 40 kwacha, the one we just calculated in the first part of this question. So you have 40, and this will give you 70. So therefore, the cost of going for the movie is the explicit cost of 30 plus the implicit cost of 40, which is equal to 70. Now, given this, then, we need to ask ourselves, as a rational consumer, would you consider going for the movie or working at the campus shop? Now, we've noted that the value of working at the campus shop is 40 and the cost of going for the movie is 70. Now, given that the benefit of going for a movie, so I can take you to those solutions. So given that the benefit of going for the movie with your friend is 60 and it is lower than the cost, which is the explicit plus the implicit cost, as a rational individual, you should choose not to do it. Instead, you should work at the campus shop. This means that if you look at the deviation, the value and the benefit, you are comparing your costs and your benefits. If your benefits are more than the cost, it means you take the action. But if your costs are more than the benefits, it means you don't take such an action. You leave that action out. You have the benefit of 60 for going for a movie, but the cost of 70. You have the benefit, the value, which is 40 of going for the movie. So, of working at the campus shop. So you will see that the negative 10, which you get if you go for the movie, is bad compared to the benefit of 40 that you have if you went to work. So the best choice then is to go and work at the campus shop. Okay, so with that, let's now conclude with the marginal concept. So marginal, when we look at the term marginal, we are talking about the additional. So marginal changes then describes small incremental adjustments to an existing plan of action. To an economist, economists would conduct a marginal analysis to arrive at the best decision. To an economist, you will have to check the change in an item given the change in another item. If I'm supposed to add 1 unit of clothing to my business, how many units of the other item am I giving up or am I reducing? That gives me my additional opportunity cost. In the case of another item, if I decide to spend 2 hours studying, what is the additional marks that I'm adding? What are the additional marks that I'm adding to my grades? Marginal measures the additional value that you are adding to the already existing plan of action. With that, marginal analysis then relates to the comparison or the marginal benefit and marginal cost which we usually make in decision making. So if the marginal benefit is more than the marginal cost, it means that the action is good and therefore you get more benefits or more satisfaction if you pursue it. But if the cost is more, it means you will be landing yourself into problems. So we will talk more about this. For now, we end session 1. If you have questions, please send an email to muawelias@gmail.com. See you in the next session of Unit 1.